Piggyback mortgage is a second mortgage that closes concurrently with a first mortgage. Typically, those second mortgages are either a home equity line of credit, which is a little bit more of a flexible type loan, open-ended, or it's a fixed rate second, somewhat similar to the first mortgage. There are two main reasons that people use these piggyback mortgages. The first is to avoid private mortgage insurance. So as an example, you're purchasing a $500,000 home and you're only going to be putting 10% down. If you were to do one loan at $450,000, 90%, you would have private mortgage insurance on top of that. The piggyback structure would be doing a first mortgage at 80% and then doing that second mortgage at 10%. So you still only need your 10% down payment, but you avoid the private mortgage insurance. Now, this is because private mortgage insurance has gotten increasingly less expensive. We don't see this as much. And it's also important to note that sometimes, depending on a couple particulars with the loan structure, doing a piggyback could actually impact the interest rate on the first as well. So it's important to understand that. The second that we're seeing more and more in this market, especially a high cost area like we live in, is to keep your loan amount at the conforming threshold. So in other words, doing a first mortgage up to say $800,000, doing a second mortgage up to the $1 million range, and then putting your down payment down on top of that. The benefit to that is that jumbo loans typically have higher interest rates. They certainly have much stricter underwriting standards. So it's a creative way to get to that same loan amount without dealing with the jumbo aspect of things. So if you want to explore either of these scenarios, please know we're here to help. Reach out and we'll see you next week. I hope you found the information helpful. Certainly welcome you to subscribe and be sure to click the link below.